Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Monday, November 7th, 5:16 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we are still in a correction under the long-term 200-day moving average, trying to recover from bear market losses. In a short-term uptrend, hanging by a thread, but showing some improvement over the last couple of days after threatening a breakdown below the 3,700 area after Jay Powell pulled the dovish to hawkish switcheroo last Wednesday. Let's check over here on the trend gauge. Leaders still holding up remarkably well. You can see the green arrow there under bullish/uptrend. Short term, we're neutral. We did get a close above the 21 on the S&P, not on the NASDAQ 100 yet, and we're above the 21 on the other indexes. 50-day moving average just closed a hair above on the S&P 500, still not on the NASDAQ 100, and the other averages are above it. Continued strength will get us off of bearish/downtrend to neutral. Particularly, we want to see some enhanced strength in the S&P as we give the most weight to the S&P and the NASDAQ 100 when we're gauging these time frames. And long term, back above the 200-day moving average for the Dow Jones Industrial Average today. It continues to be the leading index. Other indexes below the 200, but we do have the green arrow there, as we are certainly seeing some attempts at some strength. Really, it continues to be the big cap tech FANG type names that are pulling this market down, although they did outperform most of the indexes today, not the Dow. And we did see another situation of where bad news was bought up with Apple saying because of COVID in the region over in China where we make all of our iPhone 14s, we're not going to be able to have the numbers, and they warned about their sales. But Apple actually closed positive today after initially it came out right before the futures opened last night, and we gapped down a little bit of about a half of a percent, a little bit more on the NASDAQ, but clawed back to positive by the open, and then kind of had a trend day with a breakout toward the end of the day. We'll review that when we go over the chart. So what just happened today? Light volume pre-election bounce above the 21 for the S&P. You can see G6 not as good as the big cap indexes today, up 0.63%. G6 is our 6 ETF composite of growth ETFs averaged up, divided by 6, and comes up with an index that we use to track the health of small and mid cap growth stocks. S&P 500 up nearly 1%. NASDAQ 100 up 1.1, Dow up 1.3, mid caps up 0.86, Russell 2000 up a little better than 0.5%, global diversified 60/40 stock and bond up 0.25%. In-house GROTECTION down 0.2% today, as one of our holdings, PI, took a hit, down 6% today. Some strange action on that, but we'll take a look at the charts. We got stopped out on a third of it, still holding the rest. And we'll review what we did when we go to the tail of the tape. But first, let's talk about our public service announcement that I try to keep to about 2 minutes or less. On Revere, we are a fee-based only, fully transparent, conflict-free, fiduciary, registered investment advisor, registered with the SEC. Our flagship portfolio is called GROTECTION, and it's designed to grow assets during market uptrends and protect assets during market downtrends. We manage individual client accounts using trend-following rules based on 3 time frames and the action of leading stocks, as I just showed on the prior page on the trend gauge. In an ideal uptrending market, such as last October, November, we will be fully invested when the 5 major indexes are all trending above all 3 moving averages and growth stocks are acting well. In a neutral market, when we start to go sideways, we'll reduce our overall exposure because the market will take us out. Our stops will start getting hit. And in a downtrending market, such as started in January, the slopes of the short-term and intermediate term will roll over, and we will significantly reduce exposure. And if we start reaching what could be the worst case scenario, that's a break below the 200-day moving average. Then we turn to a maximum defensive posture. As history shows, this is when we're at risk for severe bear markets, and this chart tells you how severe some of them can be. All the shaded ones, those are 6 bear markets going back to 1968. Average loss 44.5%. You need 80% to get back to even. If you're approaching retirement, that can devastate your best laid retirement plans. That's why at Revere, risk management is our #1 priority. If you minimize the drawdowns, the gains will take care of themselves when a more favorable market returns, and your assets will be compounding from a higher capital base. So talked about the exit rules, re-entry rules, that we have various short-term signals that we use to signal a short-term risk-reward environment, such as getting back above the short-term 21-day moving average, or a false breakdown such as we see on 1013. That's why we started dipping some toes in the water recently. If you're interested in this approach, reach out to me, Don at revereasset.com, or phone 855-REAL-WEALTH. That's 855-732-5932. So you can see here, let's go to a 5-minute chart on the S&P. And what we saw today was the gap up and then immediately selling off. But we stopped selling off early in the first half hour, came into yesterday or Friday's range. Sorry, here I'm over here. Came into the top of Friday's range, and that was as low as we went. Then we rebounded a little bit, started going sideways, had a 3.5 hour base, and then we broke out above this 3790 area and got up to 3810. So some strength came in. You can see increased volume happened at that point when we broke out of that area a little after 2 o'clock Eastern time. Let's go to a little more of a 60-minute time frame. You can see here we've got this 3800, 3824, 3804, 3796 last week. So we broke above 3800. Now we want to see if we can keep it. And the next level up is another 100-point range above this 3900 area, where we spent late October to early November, before early November meaning last Wednesday, when we broke back below it on Jay Powell's comments after the Fed. So as for now, I'm seeing signs of the market not wanting to give up. Don't know if the elections have anything to do with that. Don't know if what economic data we've seen, that we had for the most part, what should be considered an employment report last Friday that would cause a sell-off, but it didn't. And when the market stops going down on bad news, in this case, big area here, this 3700 is where we stopped Thursday. It's where we stopped Friday, and we didn't even get close to it today. The 21 held all pullback. So this is bullish action. We're still holding a small piece of our short because we need to see 2 closes above the 21 before we get out of the last of that. But let's skip to the Dow Jones Industrial Average. We got back in DDM with a close back above and a strong move above the 200-day moving average today. We started this negative stochastic last week, but it hooked back up today. So we'll see. And again, a very tight stop on this. We should hold. We're only less than 1% above the 200-day. We'll give it a little bit of room here on a pullback, but see what happens the rest of the week. Let's go to the NASDAQ 100. This continues to be weak, but had a decent day today, even with weakness from Tesla. Still below the 80 MA, never mind the 21 and the 50. Let's go to mid-caps. And mid-caps trying to get into their 200-day moving average. So basically what it amounts to is we had an undercut and reclaim of the 21 and the 50 last Thursday, follow-up strength on Friday and Monday. So 2 down days, recovered it. Haven't gotten all of the losses back from the Jay Powell fiasco last Wednesday, but not giving it up either. And note the relative strength on mid-caps continues. So really, again, what we're seeing is big cap tech being the big laggard, and Same situation for the small caps. False breakdown below the 21 and the 50 last Thursday after Powell's Wednesday announcement. Strength on Friday and today, getting us back into this 180 area on small caps, and that puts us 3.7% below the 200-day moving average. So we're certainly trying. You see the stochastic hook down last week, but we're trying to flatten that out and turn back. Just because you break, the odds favor you're going to go lower. You can see it multiple times back here, but it doesn't always happen. Here's a good situation back here last October where we broke down and we broke below, oversold, that being the 80 area, but it was only for a couple days, and we went back higher again for a couple weeks before we broke down. So we'll pay attention to the signals and the price and the volume. And what leading stocks are doing. Leading stocks have been a tougher row to hoe for us, even though I said the 21 over 21 is holding up better. I don't know if we're just getting some bad luck or we're picking the wrong names, but we've gotten stopped on more than our share, in my opinion. Oils seem to be mostly the only thing that's holding up. But for the most part, still seeing some decent charts. So let's go to a couple of other asset classes here. Let's go with gold, since it had a big move on the weak dollar last week. The dollar, in fact, that gave us our first close above the 50-day moving average. And then look how tight the contraction was. That's just saying, it's saying a couple things. One, the dollar was weak today, so we could have expected gold to go higher, but this tight range is saying we're just consolidating this big move up from 150 up to 156, about 3-4%. I want to set an alert above today's high so that I know if that goes out. We have some portfolios. Our robo portfolio is long gold if gold is trending above the 50-day moving average. So that's something we want to keep an eye on. Let's also look at, I mentioned the dollar. So the dollar, more weakness today. Second close below the 50-day moving average. See if it's just coming down to the bottom of this base that it's forming, or this range. Second close below the 50, but right now that gap up in the dollar on Thursday is looking like an outlier, as we gave it up over the last 2 days. I'm not sure, but it's got to be the euro and the yen that are getting stronger, as those are the biggest components of the US dollar index. Let's take a look at TLT. This is the long-term bond. This is not following what the dollar's doing. As this goes lower, meaning interest rates higher, you can see the hook down there also. So interest rates and the longer term interest rates and the dollar have become disconnected for now. Let's go to 0TNX. This is the 10-year yield, and you'll see it did not. So really the opposite of what the dollar did. We were expecting both of these because they were trending together to break down or to hold up together. The dollar broke down, but rates continue to go higher. So all they did is pull back and hold the 21 last week. That's the 10-year. Here is the 30-year long term. Same situation, pull back to the 21.3 up days now. Positive stochastic hook up. That stopped, opposite of what you're seeing on the dollar. As this stopped, went back up, and now has hooked lower again with that 2-day move down in the dollar. How about Bitcoin, BITO? Let's go to the 60-minute chart for that, as we did have a breakout in that last week, and we're flagging after the breakout. So here was a move up, the flagpole, the flag, a breakout, and now we're flagging again above that. Couldn't hold the 13 area. It's very frequent that you retest the pivot, but unless we break down back below this 1240, 1250 area, it's not a completely failed breakout, the way I look at things. So we did rates, we did the dollar. Let's move on to the tail of the tape now. Short-term uptrend, as I said, holding on by a thread. Put call 0.88. VIX 24. That's what I wanted to look at, the VIX. I knew I was forgetting something. So here's the VIX. Two important things on a daily chart to know about the VIX here. One is that we are absolutely buried on the stochastic and oversold, which implies that we're going to have a spike higher. However, from a technical setup, and this is a pretty steep decline here in the VIX. You can see it happens from time to time, but usually after it happens, you get a spike higher. That's the spike that I'm kind of looking for. That would correspond to a move back down in stocks. And then the question is the VIX going to continue to go higher, or is it just an oversold relief bounce that comes into the moving averages? Maybe the 26 area, again, 26 to 24 is kind of no man's land here. Below 24 is bullish, but not below 24, and also with your stochastic buried, because you're really at a risk for a quick snapback in the other direction. So keeping an eye on multiple things relative to the VIX. Fear and greed popped to 61. Midterm tomorrow, obviously. China, over the weekend, there had been big moves in Chinese stocks last week. Let's take a look at A share. These are Chinese stocks that trade only on the China exchanges, and you can see gap down on COVID lockups, 4 days up on rumors that they were going to relax. They said, no, we're not relaxing, still zero COVID, only down 2% today. Could have been a lot worse. See, I do have an alert set there, but really no intention of buying China stocks, as you just can't trust the government there. So day count, second day up, off the bounce, off 3,700. My expectations were neutral as long as we're above 3,700 and to 3,800, but positive day two up off that 3,700 area, but now into 3,800 resistance. So we got to see if we're just going to play ping pong between 37 or 3,800, or have a sustained breakout one direction or another. You can see we're at the support resistance areas, both on the NASDAQ and the S&P 500. Let's see here, oils, nat gas, ITA, and I'll show that that's up because of Boeing and the continued strength on some of the aerospace tech. Aerospace defense stocks, XLC and XLK led today, dollar down. TAN and MSOS, I'm wondering if this is if these stocks are being sold because of a perceived threat to the Senate and the House, that if Republicans take charge, they won't be so friendly to solar and cannabis. But there's a lot that even after an election they can get done before January, when the new slate of electors gets sworn in. Small cap biotech down. Big cap biotech was positive on the day, and utilities were down almost 2% on the day. So what we're focused on coming in today, and we'll look at these charts momentarily, are current holdings and then a couple of decent setups. What we ended up doing is trimming PI, as I mentioned, and buying DDM as the Dow got back above the 200-day moving average. Bottom line, light volume rally into 3,800 resistance with the elections tomorrow, a big catalyst. Not sure how the markets are going to react to it. The polls seem to be consistent that Republicans will gain seats, but to what extent, we really don't know, or what shenanigans when vote counts will go on. So current holdings and what we were focused on today, let's go with PI. Now, I don't know if this is related to that shelf offering that they put out. Maybe this is trading like it's expecting an offering to come in. There was a lot of strength on the gap up, pulled back now to the low of the gap up range. That's not a positive. We broke below the 8. We got stopped on on a third of our buy. We're still holding 2% of this position. STNG continues to act very well. This is a transportation pipeline. Nice move out of this flag, this bull flag on earnings, continues to ride the ADMA higher. On the other hand, a stock that we had a lot of confidence in, LNG, continues to underperform since it reported its earnings with the 2 days afterwards. Maybe all the sellers are out. You can see volume 35% below average today on this after 2 above average volume days. We're still holding on to this with a slight profit on it. And we still have the SPXS 2.5% short on the S&P 500. IBB, biotech that we bought on Friday, a little bit higher today. Some of the big cap techs really looking good, like Amgen. In fact, for the 5, we're up today. I didn't look at the components. I know Vertex was down, which is one of the top components, but for the 5, we're up today. There's Amgen with a nice follow-up price action after its earnings report, and Regeneron, REGN. Nice action today as it held the 50-day moving average. Okay, Regeneron. So 4 stocks that we were looking at for possible entry points: ANET, ANET. We had the nice reaction on earnings, chopped around a little bit, big upgrade, and now an inside day after the upgrade. This is good news. This is probably at the top of my list to buy. I know it's extended a little bit, but it is above this 130-ish pivot, 130 to 132 back in August, trying to get above that. Great fundamentals. Just great fundamentals, period, across the board: sales, earnings, accumulation, distribution, group strength. That's why it's near the top of the list, and it has room to go. If you look at the weekly, we're still below this long flat base that's showing there. Relative strength at a new high before price at a new high is always a good thing to see. So that's very clearly at the top. Now, First Solar, the leader, after I talked about the anomaly of the day 2 higher high on volume. There was a 1-day delay on this breakout. Didn't expect to see this sharp of a pullback, down 4.5%, but it bounced right where it should have at the ADMA. But all solars were weak today. Enphase also, which we got stopped out of on this break, broke below the 50-day moving average today. This is not how leaders act. Gap up on earnings, try to make a higher high, and then 2 big down days. Nice volume on the move higher off the low, not nice volume and not nice price action recently. But after hours, Sedge, former leader in the solar space, is up 10% after hours now. This really faded on a bad earnings report in August. Its last earnings report really paid the price, sold off hard, trying to reclaim it now, but this only puts it at 233, which is like basically right about there. Still very clearly a broken stock. BA, follow through up through the 200-day moving average, closed in the upper part of its range. Very clear accumulation. I'm absolutely looking for an entry point into Boeing. Love the action there. And STLD, Steel Dynamics, steel stocks continue to act well. This put in a nice little pullback after this strong move up, held the ADMA, and those are the 4 that are at the top of the buy list, waiting for some more clarification from the indices this week and what's going to happen with the reaction to the election. That's going to wrap it. As always, like to hear from you. Don at revereasset.com. The phone is 855-REAL-WEALTH, 855-732-5932. So remember, it's not how much you make in the market, it's how much you keep. Our defensiveness recently has cost us a little bit of gains relative to the market, but we're still crushing the S&P 500 and the NASDAQ 100 year to date. And keeping an eye on the leaders. Some of the leaders that we picked just really not doing what leaders do, and that might be more of a reflection of what's going on with the overall market. Leadership kind of seems very strange, like it's shifted from the big FANG stocks to the leaders in the Dow Jones Industrial Average. Those are very clearly taking the baton from tech and are running with it, and that's what we're evaluating for our next buys. So wrapping up Monday, November 7th, this is Don Vandenbord telling it like it is. Thanks for listening. Have a great day.